Hello and welcome. I'm your host Pooja Sarkar, and you're listening to the podcast from the bookshelves of Forbes India. I'm delighted to announce that Forbes India with HarperCollins India has launched the Reset podcast series where we promise to bring you some riveting reads from their collection. This is the third episode in this series. Our podcast is all about finance and economics, and so let's get back to basics. How to read a balance sheet. What do you look for while analyzing a company? How do you pick a stock? Basic things, but that need attention. And so I decided to rope in Mr. Anil Lamba to discuss his book Romancing the Balance Sheet and his latest Eye on the Bottom Line. Welcome, Mr. Lamba, to our show. So, when did you decide that you would like to, break down numbers for other people? What was the reason for actually writing these books?
So I never really thought of getting into this line. It just happened to me, Pooja. I passed out as a chartered accountant, decided to set up practice day one without working anywhere. Same year, in fact, in the first couple of months, I got an invitation from management college to teach, which I took on very reluctantly. But then I enjoyed it so much that it became a passion thereafter. Then the profile of teaching changed. Very soon I had to stop college teaching because practice had picked up and time constraints were there. But then corporate invitations started coming. And then individual businessmen and professionals used to invite. So one thing led to another. I don't know how. And since I used to enjoy it so much, eventually it took over my life. I left my practice behind. So even though I didn't decide it, today we train several thousand companies globally, across the world, in Europe, in US, in Middle East, in Far East, in Africa, in Russia, in India, and so on. And it was a journey of discovery. Discovery was how little people understand. When you study a subject, when you pass out, you realize, you think that you learned it now, everybody else knew it all along. And then you discover how little people know. And in this subject of mine, what a price people pay for not understanding this. I mean, the price is businesses shut down. You might be aware that I think over 90% of businesses worldwide fail. Out of businesses that fail, over 90% fail due to bad finance management. So the sense of satisfaction is you're not only teaching people the subject, but you're helping them become stronger, you're helping them survive, you're helping them prosper. So it's a great feeling of happiness and satisfaction doing this.
True.
Yes.
One thing I wanted to understand when it comes to, teaching how to read a balance sheet, what are the most common, simple mistakes that people make? What are the mistakes that you want people to avoid?
First of all, to make mistakes, you must understand this statement is so less understood. Lots of people have a mind block against finance. They don't understand, not because they don't want to, not because they've tried and failed. People have two misconceptions. Number one, that it is difficult. Number two, that it is boring. Now, my answer always, when somebody says it's boring, I said, damn it, we're talking about money. How can money ever be boring? And number two, it's, I think, an absolutely common sense subject. But because people have a mind block, they stay away from the subject. So within balance sheets, balance sheet itself is such a simple statement. We say you can not only learn how to read a balance sheet in a short period of time, but give me 3 minutes and I will teach you how to make a balance. So once you understand that a balance sheet, nothing but one side tells you where the money has come from, other side tells you where the money has gone. Now I have these two rules, which I feel if people don't violate, they will avoid most of the financial mismanagement related problems. And even if one rule is violated, they will pay a price. So the first thing you must keep in mind is no money is free. Out of all the sources of money, each one has a cost. So you said what perceptions people have, what don't they understand? Number one, this is what they don't understand. Many people are under the impression that only debt fund has a cost. Owner's capital is free. And the answer is not only owner's capital not free, it is probably the most expensive source of money available. Now, if sources have a cost, but you use these sources to acquire assets, which have an ability to earn. So the first fundamental rule, common sense rule says, don't ever invest your money without ensuring that what you will earn through the deployment is at least equal to the cost of capital, preferably greater than the cost of capital. Now, this is such a simple truism, but it's amazing how many people don't understand. First of all, they don't understand cost of capital. If they do understand cost, their perception of cost of capital is very different. So the target set for earning itself is wrong, which is way below what they should be. Second rule says not only sources have a cost, but in a balance sheet, they are shown under a heading called liability. And the reason is you got to remember none of these sources are gifts. They're liabilities, including owner's money. That means those who have given you the money today are going to expect it back sometime or the other, including owners, mind you. A banker may give you a fixed time to repay. The owner doesn't give you a fixed time. That doesn't mean he doesn't want it back. Worst come to worst, when a business shuts down, he expects this money to have been preserved. In fact, it should have appreciated. And therefore, if sources have to be paid back, how will you pay them back? Balance sheet is only two sides, sources and uses. So the sources are used to acquire the assets, and the assets have to bring the money to pay back the liabilities. But what is important is the assets should bring back the money before the liabilities have to be paid back.
So basically, money has to come in before it has to be paid out.
And it has to earn equal to or greater than what it costs.
There's one thing I wanted to understand. When people come to you, what are the most frequently asked questions to you? What are the myths that you're busting all the time?
One is this. See, finance actually is full of myths to be busted. So there can't be one or two. Certain things lead to, let's say, unscrupulous people use it to manipulate profits when they understand that the higher the inventory that appears in the books, higher the profit. Mm-hmm. So this is a contradiction by itself. How can higher inventory lead to higher profit? But higher inventory means lower consumption, because if your purchases are constant, if two people are the same, one person has a lower inventory, second has a higher inventory, that means the second fellow has consumed less. So profit becomes higher because consumption is lower, not because the inventory is higher. But once people understand these things, they misuse these understandings to manipulate. So a lot of people are looking at how to show less profit, not have less profit, but show less profit for taxation and so on. Another thing they don't understand is how fixed costs can help you magnify profits. So when you make a fixed statement, higher the fixed cost, higher the profit, again, it sounds like a contradiction. But fixed costs by the definition mean they remain fixed. So if you have a higher proportion of fixed costs as compared to variable costs, what happens when incomes go up, costs don't go up. So profits go up faster. But on the flip side, if incomes fall, costs don't fall. So profits come down equally fast. So these are all various things. I'm just giving you a few samplings of things that people need to understand. But there are lots of people, they would not be able to articulate their expectations because there's such a huge amount of ignorance. To be able to say, this is what I need to understand, you should know what there is to understand, isn't it?
That is true. Want to understand one thing, a lot of us look at companies to analyze companies as part of our work. And then there are some who use the knowledge to analyze companies to invest in stocks. And I read this line in your book. It says, "It is my belief that investing in shares is a national duty." So I want to understand, why do you say so? And if in detail you could explain our listeners on what are the key metrics while analyzing a company, when to get in the market, or how do you assess when to get in the market. So if you could just take the listeners through this important part called stock market investing, which everybody loves to hear about.
See, your one question has many questions rolled into it. So let me see if I can split them and answer one by one. So first you asked about why do I say, and I often say that investing in shares is a national duty. Even though I advocate a lot about stock market investing, I try and encourage people to invest, but I do nothing related to stock market in a professional capacity. So I don't have a vested interest over there. And nevertheless, I feel it's so important that I go around encouraging everyone to invest. Now, the reason I say it's a national duty is, so let me ask you a question. Let's say I come to you and I say, Pooja, I've got this brilliant idea, business idea. I have the idea, but I don't have the money. You have a lot of money. So why don't you invest with my business? And your money, my idea will make it a big success and all of us will become very rich. And the money that you invest, I will return to you multiplied many-fold, let's say 25 years from today. Would you be interested? Chances are you will not be interested. Why not? What will put you off is, you said, what? You'll return this money to me 25 years later? Your reaction will be, today I have the money, but what if I need it tomorrow? So it doesn't matter how attractive my proposition is, chances are you will refuse. Now imagine I come to you and I say, Pooja, I've got this brilliant business idea. Why don't you invest your money and we'll do this and we'll do that and we'll make so much money. And Pooja, whenever you want it back, I will give it back to you. Wouldn't you be far more inclined towards investing? This is what the stock market does. A stock market gives an investor an exit. Now, when you find an exit available, you'll be more inclined to invest. When you are inclined to invest, more entrepreneurs, those brilliant youngsters, those other intelligent people who are brimming with ideas, but they can't put it to practice because they don't have money, more entrepreneurs are born. More entrepreneurs are born, more employment is generated, more production happens, more GDP happens. But now imagine somebody tells you, Pooja, invest. Whenever you want, you can get it back. And you tomorrow want your money and you tell your broker, sell my shares, and you find there are no buyers. The whole thing goes fucked. When more and more of us invest, when a large percentage of our population invests, what happens is the stock market is teeming with activity. When the stock market is teeming with activity, more people are inclined towards investing. When more people are willing to invest, you see, if you want to exit, you should be able to find a buyer. A seller should be able to find a buyer. A buyer should be able to find a seller. When buyers and sellers find it easier to find each other, like I said, more entrepreneurs will be born, more production, more GDP, etc., and it is good for the country. Now in India, doesn't matter how active the stock market is, we not even touch 5% of our population that invests. In developed nations, the percentage is as high as 50%. So I feel it's a national duty to invest. And to support my point, I always say, you will never come across a developed nation with an underdeveloped stock market. That means there is a certain connection between the development of the country and the development of the stock market. I don't know what led to what. But I'm saying if we can't directly contribute to nation development, at least we can contribute indirectly via the stock market. So I feel it's a national duty. But having said so, I would rather you don't invest than invest foolishly and get in like a fool without understanding and burn your fingers, because that kind of an investor is very, very dangerous, because that investor comes out hurting and then that person never ever invests. And not only that, he goes and discourages 10, 20, 30 others from investing. That, you don't make this mistake. I did it. And such people are extremely dangerous. And therefore, knowledge, understanding, ability to read balance sheet become critical. Now you said what to read in a balance sheet. So first of all, you see, stock market investing depends on two things. Successful investing depends on, as everyone says, number one, your ability to do fundamental analysis, and number two, technical analysis. Fundamental analysis helps you choose companies. Technical tells you when to get in and when to get out. So balance sheet reading helps you in fundamental analysis. And from a fundamental analysis point of view, one is my two rules. Read those balance sheets, see what this company has done, see are they following rule 1, see are they following rule 2. most companies that fail due to financial mismanagement, out of which most of them fail because they are guilty of having used short-term money to acquire long-term assets, or short-term money is used for long-term purposes. Pick up any of the failed companies recently that you heard of. You'll find most are guilty, including finance companies like ILFS and so on. Pick up JP Associates, pick up Amtech, pick up Lanco Infrastructure. Most of these you will find they're guilty of having used short-term money for long-term purposes, which is why they went sick. And here we have a simple thing: monitor two ratios. Monitor a ratio called current ratio and a ratio called liquid ratio or quick ratio. So these are a few things, and to evaluate the health, I find two tools are very, very important. Number one, a tool called leverage analysis, and number two, a tool called funds flow analysis. These are little less understood areas, but they give you a tremendous insight.
But also, I mean, apart from just talk, because right now the markets are so bad, everybody has been caught unawares. How do you think people will be able to get out of this situation?
No, what should they get out of? These are opportunities that come once in 10, 15 years. I mean, if the
Mm-hmm.
market keep booming, that's nothing to be happy about. Unless you had bought it in the previous crash, only those people are happy. I think crashes in the markets are a great time to get in. We have seen good stocks, but selling at such crazy valuations, you feel, when will I ever buy? If I had them, I would have probably sold and got out. I'm talking about in the boom time before the crash. Now is such a wonderful time. All the people who say, I miss the bus, I miss the bus, here the bus is back at your doorstep. Jump on now. So I think today is a great time to buy. If you are a long-term investor, and I don't like intraday trading, that's not that I'm against it, but I think for that you must understand the market completely and the risks involved. But for long-term investors, blue chip shares are available at such mouth-watering valuations, because these opportunities don't come again. Of course, people wait for the market to bottom out, which it is impossible to understand, and therefore you keep waiting perpetually. So I think the two mistakes people make is they sell when the market goes up and they buy when the market falls. I think you should do the reverse. So when the market goes up, they say, oh, I've made 10%, 20% profit, let me get out. And they sell and the market continues to rise. Don't sell in a rising market. Let it rise. When it starts falling is the time to sell. Prices fall, people pick up. But it goes on falling after that. So never buy in a falling market. Wait for the market to fall and let it start picking up. So since you can't identify the bottom and you can't identify the top, when the market reaches the bottom and it starts moving upwards is the time to get in. Easier said than done, of course. And therefore the other alternative is buy at every fall, little bit, and accumulate. So these are the few mistakes people make. And but they're not, just not rocket science. Anyone who's been in the market made a couple of mistakes. They learn lessons. I hope they learn lessons. Then next time they don't repeat. But right now, you don't need anything to get out of. I think this is, I was beginning to get worried when the market started going up again last couple of days. I was saying, oh, it was actually falling. And yesterday when it crashed, it gave me a nice feeling. Not that I am in favor, or I'm a sadist or something. But I am also waiting for market to fall further to make investments in this market.
There is an interesting part in your book where you talk about how evading tax is more expensive than paying it,
Oh, yes.
And I really found it very interesting and true in the sense that over the years we've seen that the people in the workforce which is actually paying taxes in India is far lower than the ones that are not paying it, and therefore you get taxed more in various other forms of cess. There are multiple cess that have come along our way, from Swachh Bharat to water to everything. We actually keep paying more in other forms. So, if you could explain our listeners what do you mean by this and what is the whole concept about it?
This is another thing I've been passionate about. I was a practicing CA. most people come to chartered accountants to learn how to save taxes. And I was one of the rare guys who used to say, no, I think you should pay taxes. So obviously I was not very popular when I made this recommendation. But the reason I said it was because I think I've always maintained any attempt at trying to save tax is more expensive than the payment of the tax itself. Now, let me try and elaborate. You said very few people in India pay taxes. There are two reasons for that. One is there's a large percentage of people who don't have sufficient income to pay. So that is something you can't do anything about. In fact, the government should try and increase their incomes so that they can start paying taxes. But they are a very, very large percentage is below the poverty line. You can't expect them to pay. Those who are above the poverty line are still earning lesser than the minimum amount required for payment of taxes and so on. So that's one part. Those people, in fact, we have sympathy for. We hope soon they'll come into the tax bracket. But the people who damage the country are the tax evaders. Now, tax evaders are the people who earn, who should be paying taxes and who don't. And that is I think, absolutely criminal. I think they would have been better off had they paid rather than by not paying. Why? Let's first look at two things. Number one, let's say there's an honest taxpayer. That person also tries to save taxes, but that person does it through legitimate means. So that is called tax planning. Second kind of a person is who evades, who doesn't pay taxes. He earned, but what is his modus operandi? His modus operandi is, I will not disclose what I have earned. I have said both these people have not paid taxes. The tax planner's attempt is what? To either reduce your tax liability or to eliminate it. Tax evaders' attempt is what? Identical, to reduce or to eliminate. So when the end result of the actions of both these people is the country doesn't get taxed, then why am I saying that the tax planner is a very nice person and the tax evader is a crook and a criminal? Like I said, the difference in the methods. When a tax planner saves tax, that person saves tax himself, but in the process, the nation benefits even more. It's a win-win situation. Now, what does a tax evader do? Tax evader looks at his income. How much have I earned? So much. He says, I don't want to pay tax. Modus operandi is what? Just keep mum. They're not magicians sitting in the income tax department who will come to know. Now, folks, the very fact that a tax planner also did not pay tax and the tax evader also did not pay tax, I think is a very minor crime. But this minor crime of the tax evader leads to a major crime. Now, here we need to understand the simple concept of income. Every time a rupee changes hands, it becomes somebody's income and government gets a part of it. Tax evader, when he doesn't pay tax, the very fact he has not paid tax is a minor crime. But a major crime is the tax planner doesn't pay tax, but the guy is not scared to spend. He earns money and spends. He buys property. He buys shares. Tax evader doesn't pay tax, minor crime. But because he hasn't paid tax, the fellow doesn't spend. Why does he not spend? Because if he spends, there is a chance of him getting caught. If he earns money, doesn't pay tax and goes and books a property with the builder, sometime or the other income tax notice can come. If he does anything by which the money can be traced back, so his options of spending get reduced. When his options get reduced, he starts hoarding that money. And this is where the bigger crime starts. He breaks that chain. Government earns by way of taxes and it spends. But you know what? Very often they plan the spending before they earn. So spending of the government is independent of earning. So if you evade tax, do you think the government will not spend? Government will spend. So if they find your collection of income tax is less, they will, like you said, they'll add those cesses. If that is less, they'll add increase GST. If ultimately they can't collect, they'll probably print money. If they print money, the value of your and my money falls. So what I'm saying is eventually we have to pay. Whatever you do, you and I have to pay. And if we had to pay, the cheapest way of paying was the original way in which you were asked. So trying to save tax is a mug's game, according to me.
Okay, that's quite an interesting one.
Thank you so much, Mr. Lamba, for your time, and I hope you guys had a great time listening to us. And remind you to come back next Wednesday when we have a very interesting book to discuss.